Hey guys, I wanted to start off with a quote from Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the reason I kind of wanted to talk about that is because the stocks we're going over are truly wonderful companies, but they're not trading at fire discounts here, right? They're very fairly priced. It's a very nice entry point into a wonderful stock. So with that being said, today the companies we're talking about are with high gross margins and trading at a slight discount. High margins basically mean your business is keeping a big chunk of that revenue after covering all the direct costs associated with, producing or providing that service. And when you have gross margins, it really gives companies a lot more breathing room to handle unexpected expenses. And when you have these fat margins, you can pump more money into growth stuff like marketing and research and development without having to scrape the bottom of the barrel or issue debt or, dilute shareholders and issue equity. So without further ado, let's hop right into what stocks I'm eyeing up. All right, so first up on my list here is MSCI. And MSCI is basically a powerhouse investment research firm, and they crank out global stock indexes like ones that track emerging markets and world equities. They create a lot of benchmarks that big time investors use for everything from ETFs to portfolio strategies. They also whip up some analytical tools to help folks gauge risk, performance, ESG factors. Basically, they're making sure your investments aren't just chasing returns, but dodging, some of those hidden pitfalls too. Overall, if I had to come up with an analogy, it's kind of like MSCI is the GPS for institutional money managers navigating the world of finance here and helping them make smarter moves without getting lost. And if you take a look at MSCI's chart here, they're lagging pretty good amount here to the S&P 500 year to date. I think S&P's up in like the low teens here, let's say about 14%. So they're trailing by about 17%, and it's been, basically held constant at 600 since the beginning of 2025. So I think right now is a really good time to hop in on the stock. And just to show you in the bottom left here, their gross margins yearly for the last, what is this, 6 years performance we have is held constant at 82%. I mean, beautiful margins. I mean, wow. I just thought it was interesting to take a look at what some other equity analysts have to say. And you can see from this report here that MSCI's crown jewel is the wide moat index business. And it's true. I mean, look up any international ETF and it's going to be MSCI. Um, and it's just interesting that the index segment makes up 55% of their revenue and contributes 70% to their operating margin. And the CEO had to recently say that they believe AI will dramatically increase their margins because they'll be able to create a lot of new products and scale them a lot faster while significantly reducing costs as they use, AI agents over humans. To keep rolling on the good news here, MSCI is buying back record amounts of their stock. With their recent quarterly earnings report here, they just reported their highest quarterly repurchases ever. They retired 1.2 million shares worth of the stock. And I mean, the confidence that sends and signals to investors is like, hey, we're buying our stock at these prices. We believe in it. I'm a buyer. And not to mention the fact that the company is a free cash flow generating machine. I mean, if you take a look here annually from 2005 all the way up here until the last 12 months of September, they've been growing their free cash flow per share at 18% a year. I mean, that's insane. And MSCI is not trading at a tremendous discount, but back to what Warren Buffett said, it's you're paying a fair price for quality. company. So if we just take a look here to price to earnings, you can see it was trading in 2021 for 57 times, then 39 times, 40 times, 36 times, and now 31 times. I mean, so it is right on track with about where the S&P, the average PE ratio of the S&P 500 is trading right now. And you're getting a very well run company with margins in the 80% range, have been growing at their free cash flow by 18% a year. They have a huge moat around these indexes. I mean, it's a good time to buy right now. All right, and the second stock here on my list is Adobe. And as you can see from the picture here of the chart, they've been down on the 1 year graph 35%. I mean, the company's been cut into third. And it's just interesting because this really reminds me of Google just a couple months ago when everyone was thinking the LLMs, ChatGPT, Grok were going to take up all of the search queries on Google, and that's just not the case. And I kind of feel that here too, that people think AI and everything is going to remove Adobe. I think it's going to have the exact opposite effect. I think it's going to make it that much better. They're already implementing Firefly, and it's they already have their own AI components to it. I mean, I think it's a tailwind, not a headwind. But just to show you this company's gross margins, I mean, they're operating in 89%. That's even higher than MSCI's. I mean, this company is operating, think about that, 90% gross margins just about in the last 12 months. And the stock price is this far down. Like, this is very, very discounted. And I love this opportunity. This might be, this and Duolingo are probably the best buying opportunities in my opinion right now. And Adobe's not backing down from this AI wave. They dropped Adobe Foundry, which is their powerhouse model built on their own data that brands can tweak with their own IP to whip up anything from text and images to videos and 3D. And it's supercharging marketing campaigns. It's all baked into their cloud ecosystem, playing nice with their awesome analytics tools, making it the go-to for any brand. With Foundry, you can create one ad, then let a custom model spin it into different seasons, languages, formats. Adobe gets marketing like nobody else, and they're all about keeping humans at the heart of creativity. And with tools like Firefly and Foundry just leveling up the storytelling here, I really don't see how AI is supposed to be a headwind. I mean, I'm seeing tailwind here. And just to highlight some of their key features real quick, I mean, the stock price you can see in the top left chart, it's gone down, fell off a cliff. Yet total subscription revenue hasn't been stronger. Same story in the bottom left chart. Stock price falling off a cliff, revenue growing at 17% a year. Look at the bottom right chart, right? Really tells you how companies managing their money, return on equity. Their return on equity is growing by 15% a year and currently sits at 53%. I mean, these are like unrealistic numbers. And the reason why I'm buying is because the fundamentals haven't changed or only improving. AI is not a headwind, it's a tailwind, and it's trading at its lowest multiple in near a decade. All right, next up on the list here is Mastercard, and this stock really hasn't seen a dip or a pullback, but it's just been lagging the S&P 500. And given its track record, amazing fundamentals, strong moat, it makes it a really interesting opportunity right here. And if you take a look at that bottom left graph, you can see the company has 100% gross margins on their credit cards. I mean, they've just gotten to such a size that, it's near 100%, rounded to 100% gross margins here. And just to kind of illustrate the point here that MasterCard is a free cash flow animal. I mean, look at the chart in the bottom left. Their free cash flow per share is always going up. I mean, on the 1 year, 30%, 2 year, 30%, 5 year, 20%, 10 year, 20%. These guys make money and continue to increase their prices, and people still use them. And if you look at it, it's truly a duopoly. You can throw American Express in there. I really don't think they're at the level here of Visa and MasterCard. But look at the total transaction volume from Visa and MasterCard. I mean, these are billions. This is 26 billion transactions. And we have MasterCard growing their transactions already in the billions by 8.5% a year. I mean, it's a beautiful company. If you take a look at it from a valuation perspective, you can see it's the best time to buy the stock. The stock historically, looking from 21 to 25 on price to earnings, was at around 37 times, 30 times, 31 times, 34 times, and now it's trading at 30 times. It's trading at its lowest multiple on price to earnings in 5 years, making a good entry point for us. And the last name on the list here is Duolingo. I mean, they absolutely got taken behind the shed. I mean, woo, down 63% in 6 months. 2/3 of the company disappeared overnight. I mean, that is bizarre. And if you take a look here at their gross margins, another beautiful company. I mean, we're talking about consistent 72 to 73% margins for the last 6 years. And if you take a look at their fundamentals, I mean, they're arguably, besides Palantir, may not be a better run software company than this. I mean, take a look at the trailing 12 months free cash flow. Take a look at the trailing 12 months net income. The stock has always stayed in between this threshold, and you can see every time it's bounced on that blue line, it hops back up, and now it's broke that first line, for the first time since 2024, and you can see the track it took after that. I mean, I just think it's a very interesting time to buy right now. It's just bizarre. Every time I look at this graph, I got to take a double look. I mean, every metric is gorgeous. Revenue up, subscription revenue up, monthly active users up, paid subscribers up. And I get a lot of people were talking and upset about the bookings and the guidance, and Wall Street didn't like where their bookings ended up. It reminds me a lot of Spotify and of Netflix when they had their monthly active users decline on a quarterly earnings report. I think both of their stocks absolutely fell off a cliff, and they sequentially recovered, which is what I anticipate to happen here with Duolingo. And one last thing to leave you with Duolingo. After their earnings and the stock dropped, the CEO said on the call that they prefer to focus on scaling users globally, getting as many as they can before maximizing monetization. So this company isn't even as profitable as it could be yet because they're focusing on expanding and getting more customers. Can you imagine what happens when they start focusing on monetization, when they start using this private data on how people learn to train AI? That's it. That's all I had for you guys. Let me know in the comments what you would buy, hold, or sell. See you next time. And so it